I look at the data more than anything because the headlines can really throw you off track, whether it's a positive one or a negative one. I look at adoption, look at the metrics that, once back tested and regressed against the prices, have some kind of signal. There's nothing perfect in crypto. There's nothing perfect in equities or fixed income, but there is definitely signal in the data. And I just try to build models which, sort of highlight statistical significance and provide us with some sort of framework for thinking about where things could potentially go and, when risk is particularly elevated. So last couple of months I've been working on really two things, but it's crypto wide, but it was, starting with Bitcoin specifically, looking at the sensitivity of Bitcoin to liquidity. So you have done all this work with Julian on liquidity analysis. I just thought I'd dig in a little bit deeper and start thinking about, okay, so traditionally Bitcoin does this when, liquidity increases or decreases. When has been the exceptional price rises or movements in the Bitcoin price, and what has that sensitivity to the global liquidity situation been? And I found that, it's very clear that we've had like these very bullish regimes where global liquidity expands very rapidly. And when it expands very rapidly, but also when it sort of breaks out of a period of contraction, generally Bitcoin sensitivity to the increase in global liquidity increases, it magnifies. And with a lag, so does crypto. So it's kind of something that we already knew. We looked back and we could look at the price charts and go, yeah, Bitcoin rallies first and altcoins rally next, and, so be it. But this is like just trying to really quantify it. So we've got, I think, a stronger guide in terms of what the potential price will be during this expansion period in global liquidity. And, on top of that, Raoul, for the pro community, I built a something that's been irking me for like 2 years, which is, or even longer. It's like some kind of risk model. So, okay, so you can sort of understand where the upside is if liquidity increases at a certain rate. But, there are other factors at play as a market. Like if you think back at the last cycle, everyone's got PTSD as to, why Bitcoin didn't reach somewhere close to 100,000. That's what everyone was calling for, really without any sort of quantification of like why. But there's other factors at play. There's behavior, there's leverage. Typically, like these are the two big things. So if you've got ways of sort of tracking those things, and if you look at the past, then you've got a framework for understanding when Bitcoin is risky or potentially near a top. And that was sort of like the model framework, which, the pro community saw. I think in the last sort of like 2 or 3 weeks, we released that. And hopefully it's going to go up on the platform as a live ticking, risk framework that everyone can use on a day-to-day basis.
Fantastic. So there's a lot to dig into. And before we start, just observationally, I was out in the Middle East, last month, I think it was, and sitting down with like the sovereign wealth funds, and the mandate across the entire region, from Saudi to Abu Dhabi to Dubai to Bahrain to Qatar, is AI and blockchain. And not just using Bitcoin as a reserve asset, but also building the entire government infrastructure on blockchain, driving licenses, property deeds, the whole bloody lot. So it's it's fascinating to see. And then a lot of people say to me, well, if all of this money's coming in from the sovereigns, that may produce an outside return. And I'm thinking, well, if we're going from 3 trillion to 100 trillion, which is my estimate by just extrapolating out the trend rate of growth, you need larger players each time because the market cap is bigger, right? There's no way you're going to get to 15 trillion this cycle unless you've got bigger players. So it's kind of, I don't think it's what people think it is. I think it's just a function of the size of the market. The bigger it becomes, the more that those people are involved. And the more blockchain technology gets used, the more it uses the alts for infrastructure rails, for new forms of compute and storage and all the other things that are coming. So I just thought it was interesting because everyone's like, oh my God, it's a super cycle because of this. I'm starting to err towards, well, we've talked about this before, a longer cycle, just because the business cycle is still below 50. So generally it takes a while to climb up. And then we use the GMI Financial Conditions Index, and that has a 9-month lead. And with the dollar breaking down even today, it's starting to suggest that this may go even into Q2 2026. So it's like the whole cycle got shifted because rates didn't get adjusted and the dollar was sideways for a period of time. So it feels that potentially there is a chance, and again, there's no guarantees in this world, that we're more like 2020 than we are in 2021. Or it's spookily similar to 2017 for me.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.